Hi, welcome to Let's Talk Bonds, the bond market podcast from INR Bonds. I'm Arjun Patsati, and so many things to talk about, with so much of volatility in the markets. But the main theme here is that our bond markets starting to factor in a sharp fall in economic growth. The market indicators do suggest this, just to give you a basic macro view of what levels are we looking at here. One is equity markets are clearly down sharply. The volatility index is rising sharply. You have the currencies all over the place. You have oil prices falling very sharply on worries about consumption. Then you have the 10-year government bond yields in India falling very sharply. You have the US Treasury, 10-year US Treasury yields falling sharply. You have the credit spreads, that is the difference between the 10-year government bond and higher yielding corporate bonds rising, so which indicates that credit risk is high due to facts of delinquencies, etc., in the loan books. And gold is at higher levels. Gold is at close to record highs. You have cryptos that are trading at higher levels, etc. And all the risk factors do seem to point out that there is a risk aversion in the markets, and this risk aversion is actually uh, pointing fingers at a sharp economic downturn as well. Uh, just before we go into the main topic, please do follow us on all podcast channels. Let's Talk Bonds is a monthly podcast from INR Bonds, and we take you through all the happenings in the bond market for bond investors to take a calculated call on their portfolios, bond portfolios. Please also be aware that bonds carry interest rate risk, credit risk, and liquidity risk, and risk of default, which is credit risk. And interest rate risk is when prices can go down or can go down from the purchase price of the bond. And liquidity risk is the impact cost of selling the bond in the market can be high. These are the risks that investors need to watch out for. Now let's get back to the podcast. Yes, clearly there is a huge tumultuous time awaiting markets. A lot of indicators pointing to a lot of happenings around the globe and India too. So let me get down to the Indian markets first. Now, what are the main factors? What are the uh, main data points that we are looking at in the last 1 year? One is that if you look at the credit growth in the banks, which RBI reports on a fortnightly basis, in the last 1 year, credit growth last year was growing at over 20%. Now it's fallen down to 11% levels. So clearly, there's a sharp deceleration in credit growth. The second data point is that the liquidity, in the liquidity point of view, the FX reserves that was at $700 billion had gone down to $640 billion. Now it's at close to $670 billion. And this is again pointing to the fact that a lot of liquidity has gone out of the system because RBI had sold dollars. Recently, they have infused liquidity. I'll come to that points again. The third is that the 10-year GSEC yield has come down from levels of 7.10 last year to around below 6.50% as of now, showing that markets are awaiting fall in economic growth and rate cuts and more liquidity infusion by the central bank. Then the other data point is credit spreads. Credit spreads have gone up. Our INR bonds retail bond index, which tracks the 3-year constant maturity bonds uh, from a rating of AA and below, had the spreads have gone up last year by about 110 basis points, and this clearly indicates that there is rising risk aversion in the credit markets as well. So all this points to clearly that the markets are worried about what's happening both domestically and globally. And this is pointing to the markets expecting that the central bank, RBI, is going to make sure that there is enough liquidity in the market and that the rates are lower so that all other aspects can be improved on. So RBI is set to announce their annual policy review on the 9th of April, which in the coming 2 days. And it's widely expected to cut the repo rate by 25 basis points. They have already cut it in the last policy meeting in December. In February 25, they cut it by 25 basis points from 6.5% to 6.25%. And in this meeting, they expected to cut it by 25 basis points more. And the governor will definitely comment on the fact that the rates, there is worries on the economy, but also the fact that there's so much volatility that the RBI will have to manage the volatility. But what RBI has done, specifically in the last 2 months, has been very, very decisive actions on liquidity. They have infused about 250,000 crores through government bond purchases, and they have announced 80,000 crores purchase of government bonds in April in 4 tranches of 20,000 crores each. So that would be about 330,000 crores of money they have infused through. This is long-term long-term liquidity, structural liquidity infusion, where the money goes straight to the system and stays there because RBI is buying government bonds. And indications are that in the secondary markets too, they have bought in a lot of government bonds and close to, so markets are factoring, saying about 4.5 lakh to 5 lakh crores of liquidity has been infused through government bond purchases. The second aspect is that RBI has also done 2 tranches of dollar swaps of $10 billion each, which is a 3-year dollar swaps where they bought dollars now from the market and they sold it and forward 3 years down the line. By doing this, they've infused about close to 170 to 175,000 crores of liquidity. So 175,000 crores of liquidity. So put together with the dollar intervention and the government bond purchases, liquidity infusion has been close to about 7 lakh crores. So the system is system liquidity definitely that this system liquidity, as I mean the banking system liquidity, has been was at a sharp deficit of around 2.5 lakh crores to 3 lakh crores in the last couple of months. But now they come back to surplus because of the huge liquidity infusion by the RBI. Now the question markets are asking is whether this liquidity infusion can translate into growth in credit and other growth in credit, which has slowed down considerably, as I mentioned, from 20% plus credit growth to 11% it's now. But here definitely the markets are turning risk covers on credit. What we have seen is in the last 1 year, the credit growth, which has been running at over 25%, 20% plus, and the NBFC credit growth has been running at almost about 22, 23% CAGR in the last 4 years, have led to a huge amount of, has led to a credit boom in the country. And this is starting to show signs of stress. So first we have seen microfinance, the industry coming down stress. Then we have seen other industries as well, other sectors as well coming down to stress. So every aspect of the lending community is seeing stress in their balance sheets and books. And the indications are that most of the lenders are definitely slowing down the growth, being very prudent on the lending, tightening the lending norms, and maintaining their liquidity position in case of further stress going forward. So that clearly what it definitely means is that the markets are going to be more inclined towards high quality credits and obviously government bonds for falling interest rates where prices rise and they are making capital gains. In the last 1 year, actually, investors in government bonds have made over 12%, 13% in some of the bonds they have invested in. And they will also be focused on the markets if there's enough liquidity and lack of credit growth. There'll be a lot of interest in higher yielding credits, which in the near term, it will be more inclined towards AAA and AA and very highly rated credits. But there could also be interest in other credits where the liquidity situation is comfortable, the delinquencies are managed well, and the outlook for the next 2-3 years is pretty much stable, even if growth doesn't happen. So clearly, this is a market where markets will look at more stable returns It's more of a bond investor market than an equity investor market at this point of time. Even though book values have price to book values have dropped for a lot of lenders, but markets will be very cautious on giving in risk capital in terms of equity, but they may want to look at in terms of stable fixed coupon on the bonds that they invest in. On the global front, the tariff war is going on very sharply. We are seeing the volatility, retaliation, a lot of noise happening. So this noise is unlikely to come down in the near future. There could be a basic premise that INR bonds is looking at is that, and this is a personal view. I mean, I'm saying basic premise that I am looking at. The personal view is that if there is less imports to US, current account surpluses with exporting countries could go down. That means they will have less money to invest in US treasuries and US assets, and that could lead to the Fed becoming a large buyer of US treasuries, which would mean that the US could would have to boost internal consumption. They might have to push up their fiscal deficit, and that could either lead to a Japan-like scenario or lead to higher inflation, leaving the Fed in a different kind of a situation. The globally itself, a lot of countries who are losing export surpluses revenues could start to look at boosting internal consumption, which would mean lowering interest rates and pump priming the fiscal deficit. So bond markets are going to be a key factor in the whole coming in the next few years, given the way the markets are going, the economies and the markets are going to behave. So thanks for listening in, and do, like I said, do follow us on all podcast channels, and do send in any queries and comments to us if you have any, and reach out to us if you have any more queries and comments to make.